Most economic models start with the assumption of a rational agent, someone who evaluates options objectively, calculates expected utility, and selects the most advantageous outcome. This, of course, is not true, as we have stated before in practically most of the videos on this channel. Not just in the sense that real people don't live up to the rational ideal, but in the more serious sense that many of the decisions that we call irrational are actually adaptive or even rational in the world of uncertainty, volatility, and limited information. The rational agent is a straw man. In practice, people rely on emotions, habits, shortcuts, and context to make decisions for them. However, despite all this irrationality, people survive, they thrive. They navigate markets, relationships, careers, and uncertainty in ways that no rational utility maximizer ever could. This isn't about defending every bad decision that people make in the markets. It's about recognizing that bounded rationality is not failure but function. And in some contexts, what looks irrational under textbook assumptions in finance is actually the best possible behavior. We don't need a theory that shames people for not being rational calculators. We need a theory that explains why they act the way they do and what this tells us about risk, markets, and human behavior under stress, which is practically finance in its most essential. I call this the irrational agent theory. Not all experiences are remembered equally. People don't recall every moment of a trade, a downturn, or a client meeting. They remember two things: the peak, which is the most intense point, and the end, how it concluded. This is called the peak-end rule, and it distorts how people evaluate outcomes over time. For example, a fund manager delivers strong returns over 3 years and then gets crushed in quarter 4. Investors don't remember the average return, they remember the final crash and redeem themselves. Or for example, take client service. A wealth advisor may provide solid, consistent support for years, but one bad experience near a key deadline or the end rewrites the entire narrative. The client leaves, even if the overall track record was solid. In both cases, the memory of the experience doesn't reflect the actual performance. It reflects how the experience felt to somebody, and when that feeling peaked or bottomed out. This becomes even more important in volatile market environments. A portfolio may be objectively well structured, but if it causes acute stress during a financial crisis, that peak emotional moment will anchor how the client remembers the strategy, even if the recovery was swift. So that means that our memory of things is driven by the peak of something, or peak of a sensation, or the ending of a sensation. So that means that performance or actual performance is not really tied to our emotional memory. Risk tolerance is recalibrated not by education but by our personal experience. Understanding the peak-end rule isn't about manipulating memory, it's about designing client experiences, product timelines, and communications to avoid catastrophic emotional spikes. So you can use this to your advantage. You make sure that the peak is very good, or you make sure that the bad peaks are low. And you make sure that people end on a good note, always. This is a finance rule as much in dealing with clients as it is in real life. These are the periods of a friendship, or the periods in a portfolio, or the periods in the market where decisions based on these will be the ones that most people, or even you yourself, will remember. A purely rational investor, in theory, should sit tight during a market crash, ignore the panic, rebalance based on fundamentals, and stick to the models. But in reality, people panic, sell low, chase highs, and make erratic changes under stress. These aren't just mistakes. Sometimes they're survival behaviors, shaped by environments where short-term ruin was more dangerous than long-term efficiency. If evolution didn't optimize us for compounding returns, it optimizes us for survival in the now. In this entire video series, I have captured so many parts of human irrationality documented in psychology and applied it to finance. Loss aversion, for example, overreaction to recent events, the peak-end rule, and the availability heuristics. In the real world, with career risk, liquidity needs, and limited cognition, these so-called errors can actually prevent catastrophic mistakes. A person who irrationally holds more cash than optimal may underperform in the short run, but they also avoid the leverage spiral that ends their portfolio permanently. A trader who overweights gut instinct may miss the symptomatic alpha, but they may also avoid being trapped in a rigid model where the regime shifts. A trader who overweights gut instinct may miss certain cues, but they may also avoid being trapped in a rigid model that is currently outdated and cannot be used in today's financial market. I know I have been using irrationality as a scapegoat throughout the series, but sometimes it may not be a bad thing. For example, if everybody acts as a utility maximizer, markets become fragile, because we immediately rush towards what seems to be the best alternative. If we didn't have different biases or different philosophies of how to invest, then the market will shift erratically pretty much every single day as people try to optimize like robots. But here's the flip side. These behaviors can also create exploitable patterns. If most people are loss averse, a few players can systematically harvest that by being less emotional. If most people overreact to certain trends, contrarian strategies are proven to be workable, but only if you can bear the psychological pain of underperforming while the crowd panics. So irrationality isn't just human, it's structural, and understanding it is the first step towards building systems that either accommodate it or profit from it.